Today we're doing a review on TSLY, the covered call income fund that tracks Tesla and yields about a 65% dividend monthly. We bought the position earlier this week, and it's a contributor to our income, which is about $104,000 per year. TSLY and OARK. See, as you can see here, TSLY and OARK, SLGs in between them. They pay us about $200 in dividends per month, which is not bad considering the small amount of money that we have in the two funds. We plan on getting OARK up to 5 and TSLY up to about 2,000. That's what I'm thinking. I don't like to have too much stock exposure. That's why I keep all my money in funds. As you can see here, all my money is in concentrated in these index funds up top. They're all 4-star and they pay nice dividends and they track the overall indexes, so I feel safer there. But for the more risque positions like an OARK, we keep those at 5K. So all these 5K positions here, you'll see that OARK is getting there. We have 3,600 in it, about 4,000 in it, and I'm trying to add another 1,000 on any weakness. I'm just waiting in, like I told you guys, and trying to keep my position size small and see how this thing works. TSLY, we have about $1,300 in, and we're down 10% in. So let's go explore TSLY and see what's happening. Is this 10% something to be worried about, or is this all normal? So TSLY, we know it's down, but let's look at Tesla first. Okay, Tesla, because that's the underlying that it tracks. Tesla is down from its highs. So I'm feeling okay about TSLY being down with Tesla. That's what's supposed to happen. So Tesla was at 207 and now it's at 185. So if we do the math on that, 207 to 185, that's 10%. You see that? 10% down recently in Tesla. So let's go look and compare that now to TSLY to see if the NAV erosion was good or bad. So TSLY, we have the high here at 1725 and we're at 1486. So 1725, 17.25 to 1486. What do we have? We get 13.8%. So we're losing about 3 to 4% in NAV erosion to TSLY. So I'm okay with that because everyone knows that when the stock drops, the position's going to drop, especially since TSLY sells calls and puts. Review our last video on the holdings of TSLY. We went into the fund's prospectus and we looked at where the strike prices were for the calls, and I believe there are 205 and 210. So you're going to have some upside in Tesla if it goes up from here, because the calls are a considerable amount away from the current market price. So the current market price is around 185, and I believe those calls, reviewed that last video once again, I believe the calls are around 205 and 210. I'm not sure. I'm not so much worried about the upside participation in this stock because you're not playing TSLY for upside participation. You're playing TSLY as a way to play Tesla after its 100% move that it had up. So Tesla was up from the lows from 100 to 200, as you can see here. So these lows that were set here were about, at 100, and again the stock's at about 200. So it's had a 100% move in a short amount of time. So Tesla is gonna pull back. It's gonna digest this move, and the way to capitalize on something pulling back like this is to sell covered calls or sell calls in TSLY's case, because they don't own the shares outright. That would be covered calls. They sell synthetic calls. So they don't need to own the shares. They just sell the calls, naked calls. So look, Tesla had a move up from 100 to 200. Everyone's aware of that. Okay, the question is, and we failed at the 200, at the 200-day moving average and $200 price point. Those just happen to line up. That orange line is the 200-day moving average, which is where resistance always is. And the stock failed to get above that, as you can see. And it failed resistance here again. However, the moving averages are converging, so this could set up a higher high and higher low scenario for Tesla. Yes, it's up 100% from the lows, again, roughly. So it could even fall back to 150 and still be up 50% or so from the lows. In this case, you're going to see TSLY fall. However, you're collecting the premiums in TSLY, and that offsets the loss. So if we're down 10% in TSLY, the dividends that we're getting, about 60%, we're still up 50% in the position at the end of the year. So Tesla looks like it's just had its typical pullback after having a large move. That's okay that Tesla is falling because the stock is falling. It's going to track the stock somewhat, but the dividends are paying back these losses. So will the dividends stay high? We did just see a dividend cut on Seeking Alpha. Yieldmax Tesla option income strategy ETF declines by 8% to 0.82. So yes, we had a little bit of a dividend cut. We've been seeing that. I went, by the way, into Tesla and saw that we're getting dividend reductions every month. So 99, 90, 0.29, then 90.23, and now 0.826. So the dividend keeps falling, but that's not because the fund can't sustain these yields or too many people are buying in, like some people are asking. That's simply because, as the stock falls, the call options are less expensive. They get cheaper. And so when the stock falls or goes sideways, those call options again will get cheaper, so that the premiums will erode. But as the stock gains steam again and goes higher, the premium will increase because the volatility will increase, and that should keep the options premiums expensive and elevated. So right now we're seeing cuts to the TSLY dividends. I get it. The stock of Tesla is falling, and we're just going sideways and consolidating after the 100% move up. So that's creating some type of NAV erosion, as the premiums are not as high anymore in Tesla. They're sort of drying up. And as the stock falls a little bit more and digests a little more, these premiums will continue to get cut, in my opinion. You'll see dividend cuts, but it's not a sign of negativity or a reason to worry about Tesla. I think, again, when the fund is just going sideways, that's what's going to happen to the options. They're going to dry up in premiums. The fund will eventually resume its uptrend as Tesla resumes its uptrend, I would imagine. Actually, the fund, Tesla, might just go sideways, but Tesla will resume its uptrend, and that's when the options premiums will increase, and that's when our yield should increase again for Tesla. Yeah, I don't think the yield is static at 65. It could drop when the stock drops or goes sideways, and then that yield could increase as the premiums increase, as volatility increases and the stock moves higher again. So Tesla, we're down 10% in. I'm not worried about it one bit. The stock, it's down with the stock, Tesla, and as Tesla is digesting that large move that it made from the lows. So this is normal. If you were a previous owner of Tesla, like many of my subscribers are, they're using this fund just to do what they're supposed to do, sell covered calls after the run up. You don't want to sit there and hold the fund when it for no reason, when it doesn't pay a dividend. So you sell the options to get a little bit more income out of the play, since the play is kind of dead now and going sideways. So this is a common strategy for people who are long the stock of Tesla, who especially have large profits but don't want to sell because they don't want to take a big tax loss or gain. They don't want to have to pay for those taxes when they sell. So they sell the covered calls as a way to just generate more income out of the position. So Tesla investors are probably happy with this right now because they're trading the stock Tesla for the income of TSLY at these highs. If you're just a Tesla investor and you've just you've never been in Tesla and you want to buy Tesla and play it outright, well, TSLY is not the way to go. It might be the way to go at this moment, but you probably want to have a little bit of both. You want to have some Tesla stock and you want to have some TSLY around the highs. So whenever Tesla moves up or starts digesting in a sideways pattern, you want to have some TSLY to squeeze more income out of that. Now, you could even be more conservative than that, kind of like me, and you want Tesla, but you don't like stocks as much because Again, they don't pay the dividends, and they don't qualify to banks for loans, and that's what I'm big on in this channel with. And so you want to play in a basket of stocks like OARK. So that's why I'm putting more of my money in OARK, because as we all know, ARK holds Tesla and ARK, and Tesla is ARK's largest holding. So if we go to ARK and we go to portfolio, you'll see that Tesla is still the largest holding. They've cut back Tesla a few times, Kathy Woods, but it's still 9% of the fund, 10% of the fund's assets. So you're getting an indirect way to play Tesla through OARK. So you can either play Tesla outright, but then you should just own stock and sell cover calls through TSLY after the move's up. If you want to just own Tesla outright right now for the first time, you can do that. But the stock has had a big move up recently. I don't know if you'd like to just do that, but you can start with a small position of Tesla here and average in and dollar cost average down. That's nice too. And if you just want the basket of stocks, go with OARK, because Tesla is the largest holding of that. So I think this will do it for the video. I had some notes prepared. There's not much here. I just said Tesla's down 10% from the highs, and TSLY is down 14%. It's perfectly normal NAV decay, in my opinion. You know, the puts go down because they do sell puts as well. So the puts will be going down with the position, and the call positions are up. So those are kind of offsetting each other, because when you sell calls and the stock falls, now you're up in that call position, but the puts you'll be down in. But we need the puts because that's how it keeps up performance with Tesla as it rises. So the puts kind of make it mimic the puts make it mimic the stock, and the calls just cap the upside of the stock, if that makes sense. And yes, they declined their dividend. They dropped it to 8%. But again, that's because options premiums are drying up. The stock's going sideways, digesting its move. This is a normal thing. All right, my other covered call funds like JEPI or QYLD or RYLD, they drop their dividends too when volatility decreases or the fund goes sideways or this fund drops. So when the volatility picks up again and things resume to their uptrends, you'll see these dividends pick back up again. So TSLY, to summarize, not worried about TSLY's performance right now, down 10%. It's normal. It's following Tesla. It is eroding a little bit more than Tesla, but you're getting paid the dividends to offset that erosion. If Tesla just goes sideways for the next year, TSLY could be one of the best bets out there, because you're still going to probably collect 30 to 40 to 50% premiums along this path. And so if you hold this for 1 year and Tesla, let's say Tesla goes sideways from here on out for the rest of the year and next year, kind of digests. Well, because it's up 100% from the lows. Well, yeah, if you hold this fund for 2 years, 60% times 2 years, let's just say 50% if they cut the dividends, you're at 100% gain in 2 years. So you've cash flowed the position in less than 3 years just by holding the TSLY fund, so, and collecting its dividends. So I really like TSLY. Very thankful for my subscribers for recommending it to me. I'm going to be doing coverage on the next funds that come out from Yieldmax when they do the Apple and the Berkshire Hathaway funds and things like that. So I'm going to definitely be on those when they launch those funds. Stay tuned for those videos. And if you have any questions or any more information to add to this videos so that we can all benefit and learn from, please post those in the comments below. So again, I hope you enjoyed this. Let me just look at one more thing for you, performance and value, just to show you how we're doing with all this. Even though we're down in TSLY, it's okay, because when you compare it to the S&P, my performance to the S&P and NASDAQ, you can see that we're beating the market. So we're up 16% for the year. We're up 16% for the year. The Dow Jones is up 0.6. The S&P is up 6%, and the NASDAQ's up 15%. So we're beating the market still with this strategy. And when you look on a 3-year strategy, you see that we're dwarfing the market. And that's because we're just simply using leverage, and I'm using my margin right now to buy TSLY. So on this margin here that we have, which is about 300,000, in margin. Now it's down to 275. We're using this margin to get more income out of our portfolio. So whatever the market does, we're going to do times 2 because the portfolio is about 350. So if our margin is about the same, 300, then we're going to double whatever gains we have. We're going to double the market's performance just because of leverage. And we use things like TSLY and OARK and all these other funds in between to get the outsized dividend returns, which then pay back the margin. So if I'm making 100K in dividends per year, that will drop my margin by 100K each year. So in 3 years, that margin is gone. The margin is paying me, it's charging me 5% interest. So it pays me to be in a TSLY. If I'm making 65% dividends in TSLY or whatever it is, minus the 5% margin, I'm still coming out way ahead, 50 to 60% ahead. And that's why my performance is what it is. I'm just using leverage through dividends and doubling what the market does. So I hope, again, this has been informative to you. If you have any other ideas and ways to play Tesla or TSLY, please leave those comments below. Last thing I want to say is I hedge with SARK. See short ARK? I hedge with SARK. So I'm down in this, but I hedge OARK with SARK. So that's another idea you can use. If in OARK, if that were to just tank, if ARK funds were to tank for some reason, SARK would make up for that. And then the dividend of OARK would just pay back the losses anyway. If I'm down 20% in OARK, I don't care because the dividends, see I'm down 5%. If I was down 50% in OARK, I would not care because the dividends are 50%. So I'd be at a break even by the end of the year. The next year, I'd be up 50% if we just held sideways. Now, if we keep holding sideways in these funds, then the dividends will dry up because the premiums will dry up. But these funds are exciting growth. They hold exciting growth companies, OARK and TSLY. And these are companies that are going to be around for the future, and they're going to have a lot of investor demand. They have a lot of growth still in them. So there will be a lot of volatility left in these companies. I think the dividends will always be there because the volatility will be there. So if you thought that I left anything out, or if you have any more ideas, please let me know and leave those in the comment section below. Thanks a lot.